this is a special treat that we have here. We're working on some camera angles here. The special treat to get in here, Steve Rattner, Charles Peabody, and Brad Hintz to all join us here. Here they are lined up like ducks. I want you guys to listen to Arthur Levitt. This morning, I spoke to Arthur Levitt, and I asked him about our banking system, and I simply said, is it a cartel?
The way it has developed in recent years, our banks have become larger and larger, and more of them are too big to fail. And the committee of regulators that is going to designate institutions that are too big to fail are going to have a hard time exempting any of the large banks from that designation.
Arthur Levitt, my question about a cartel. Here's three people beyond experienced at this. Steve, let me start with you, and I want you to jump in and ask questions. Where are we? I mean, Andrew Sorkin's made his movie. I don't know if you were in it or not. Were you in it, Brad?
No, I was not.
Okay, Charles, were you in it? I wasn't in it. Anyways, Andrew made his movie, and we've moved on 4 years into the crisis. I guess everybody but Jamie Dimon thinks this is a cartel. Are we a plutocracy? Are we a bigger, more concentrated financial system?
Well, we are a bigger, more concentrated financial system, but I don't know that degree of concentration is the defining issue as to whether we have systemic risk or not. Canada has a more concentrated banking system than we do, and yet they went through this whole meltdown without a problem. The problem we have is we have a patchwork regulatory system. We have no real systemic risk resolution mechanism, notwithstanding Dodd-Frank. We are, in my opinion, we are no closer to knowing what we would do with a failing big bank today than we were 3 years ago.
Charles, do you agree with that? Well, we're no closer?
I think we're putting in place these living wills, which will get us to a step further towards resolution of a failing institution.
Brad?
I think we're much closer to Canada than we think we are.
We're closer, we're closer
and
to
that,
Canada. We have the Stanley Cup, they don't, but that's a different story. But we're closer to Canada.
I would hate to be a non-investment grade corporate treasurer. My only choice will be to call Jamie or Bank of America and ask for LIBOR-based loans, because all of the financial engineering has gone away. Now, investment grade, different. It's competitive. But, it's changed a lot. There's no First Chicago left.
That's what I wanted to stress. When you use the word cartel, it implies a pricing power. And I think when you talk about pricing power, it goes down to the product level. And some products they do, others they don't. The big investment banks are now talking about the technological expenditures that they're making because of the deterioration of pricing power in some areas.
So would you guys break up the banks? So if you see this problem, and I'm not saying it isn't one, what would you do? Would you break up the banks?
No, I'm not talking about breaking up the banks.
Well, how do you get rid? How do you create?
You can have a banking sector that's going to be powerful, and let's think of our large banks. And in a normal environment, normal meaning there's demand for credit, their performance should be pretty good.
But you made the point, which I accept, that there's no First Chicago anymore. You now have 2 or 3 huge banks and everybody else. So how do you provide the kind of credit the economy needs if we don't have a banking system that's configured to provide it?
That's one of the prices of getting rid of a shadow banking system, isn't it? Which is cost of credit just went up. We haven't seen the cost of credit go up yet, right? Because the oligopoly has not used its power yet.
Within the banking system that we have, and each of the ways that you three look at it, bring up this chart, if you would. Long-term view, we've shown this before. This is a broader real rate. We usually look at 2-year yields, LIBOR. Here's 10-year yield, and down we go to a negative real rate. A rare event here. Charles, have we been too accommodative to assist our banks? Is it time to get restrictive and make it tougher for the banks?
Well, I think you do at some point in the cycle, and we're probably there, have to make the decision to pass the stimulus from public sector, private sector. And I think in order to do that, you have to provide some regulatory clarity on what the rules are going to be going forward. And this is hindering, I think, the bank use of capital to promote the economic growth, is the lack of clarity.
Well, look, you can make an argument that the 10-year rate is depressed today because QE2 is still going on. Right. But QE2 is going to end in 2 weeks. And then the 10-year rate is not going to reflect government policy. It's going to reflect the fears in the market that we have a problem with growth and that we have more risk on the downside than we have on the upside.
Dodd-Frank, Charles, Brett, I want you to jump in here, though. Dodd-Frank and all of it around it, do we have any more clarity than 6 months ago or 12 months ago?
Yes, you do. I mean, it's not perfect. There's uncertainty about it. It doesn't look like the regulators are going to set rules that are going to kill the capital markets businesses, right? It looks like you'll be able to maintain some level of market making in the trading books. We know capital charges are going up. We can estimate where they're going to be. The street's taking actions to prepare itself for a world of much more capital, but we don't have the whole we don't have the whole story yet.
Elegant chart one, bring it up here. I want to show, I was stunned by this chart. Normalize industrials and financials, S&P 500 back 5 years. Obviously the financials flat on their back and the industrials really doing well here. Does this mean generally that you buy straw hats in winter? So much gloom on the banks. Is it remarkably attractive now, Charles?
Yeah, I think we've gotten to the point where we're discounting not necessarily a recession, but certainly a worst case scenario in these banks. And so I think at this point they stop underperforming and may become market performers or even outperformers once we get some clarity on the regulatory issues.
Brad, you've been patient. Well, go ahead, Steve,
I was just
please.
saying, but isn't part of why these financials have been so weak not necessarily entirely the weakness in the economy, but the fear about the capital charges and what that's going to do to the ROE? And therefore, I don't know what clarity we have at the moment when people are talking about 3% surcharges and 7% surcharges and all these kind of numbers.
Well, we're going to get some clarity around June 25th when the Basel Committee meets, and then further clarity in November when G20 meets.
Now, we'll bring up a Hintz note, then we'll do a Peabody note. Morgan Stanley caught in the wake of an operating environment while uncertainty on the secular changes on implementation of regulation keeps investors paralyzed. Is the firm worth more dead or alive? Are we going to see more consolidation and breakup of financial firms?
Well, we ran the numbers. It actually is worth more dead than alive.
28%.
What that really says is the market is so discounting the future earnings of the trading book that you can in essence buy an investment portfolio, a trading portfolio, for less than what it's worth. And will Morgan Stanley break it up?
But could it also mean that the market doesn't believe the assets of Morgan Stanley are worth what they're carried at book value at?
That's another way to think of it. Or you could make an argument that that they're going to stay in a business below cost of capital, and therefore the tangible book is going to drop and drop.
Charlie, Tom Brown says he's buying Bank of America for no other reason than it's 56% a book. Is that a good reason to buy a stock?
No, cheap can get cheaper.
Yeah,
but
thank you.
I agree with him, actually, that I think the stocks are getting washed out here, and capitulation has entered this group.
Morgan Stanley, the chart here, this is the Hintz math, 28%. More dead than alive. They break it up. What will Mr. Gorman do, Brad Hintz?
Mr. Gorman will stay the story. I mean, he will continue to work on retail. The problem that you have is the payoff is so far out. They're working on fixed income, but the payout is a year away. They're working on retail. The payout is a year and a half away. They'll get to it, but unfortunately, that is the definition of a value trap for many investors.
Steve, jump in with a question,
What's
please.
their biggest problem? What's their toughest challenge of all these different challenges?
Retail is turning out the savings from retail are turning out to be longer to get to than what we had estimated, and part of that is because of the technology. They have 3 separate systems in terms of their retail business. They have to integrate all 3. That's the critical path. So unfortunately, a lot of the savings come after you've integrated the systems. Then you can cut back on the staff, and that's what you need to get to the 20% pre-tax margin they've promised.
M&A right on cue. Nice scheduling for this set of great people. Capital One said to be near takeover of ING Direct for $9 billion large. Charles Peabody, your research note on Citigroup, they're moving quickly and with a certain methodical basis here to free up a lot of their balance sheet, aren't they?
They are. I mean, in order to hit their Basel III goals, they're going to have to take a lot of mitigating actions, and selling off minority interests, using up their DTAs, changing the risk weighting mix of their asset base. Those are things that they're moving quickly on. The problem is the environment's starting to turn against them and the rest of the banking industry. From mid-2009 to 2010, we had asset prices improving. Now we have asset prices deteriorating. If you look at the ABX, the AAA tranche of the subprime index, it's dropped pretty dramatically since March 31st. That's going to show up in a negative AOCI, adjusted other comprehensive income, which starts to work against your capital.
Steve, ask a question here about Citigroup. I'm curious what you would ask.
I guess my question about Citigroup is Vikram getting, it's the same kind of question we asked about James Gorman. Is Vikram getting his arms around this? Is this going to work? Is he going to tame all the lions?
I think he is. I think he's making the right strategic actions, and he's got an advantage with his international franchise, although that right now is not considered a positive given the slowdown in India and China. But I think it will turn out to be a positive in the long run.
I'm fascinated by the reverse stock split. What did that signal to you? That chart, go back to this chart. Does everybody understand the fiction of this $37 a share? That number in the upper left-hand corner is 500.
No. What it signaled is that nobody thought the stock was going to go back to some reasonable number on its own, and therefore it's a capitulation. That value on the left side is gone, and so you basically reset it so you have a normal-looking stock price. But it means that nobody thought the stock was going back to $30.
Do we see layoffs this summer? Do we see layoffs this summer?
Yeah.
Routine or more than routine layoffs?
No, you don't need to fire lots of people. You just need to fire expensive people. And that
would be Victor, the camera guy. Whoa, be careful here. We're going to see more layoffs, seriously.
The percent of MDs in fixed income is going to drop. Which is
ruthless.
It's 15% at well-run firms. It's 20% at badly run firms. It'll get much closer to 10%. So you're going to change the shape of the pyramid. 40% of the comp goes to MDs.
Steve's dying to jump in here. Go ahead.
No. I'm listening attentively.
I would just add that it's going to be product area by product area. I think they continue to build wealth management, but they continue to pare back in trading.
But they're all going to need Bloombergs, right? Just say that, please. Charles, when you look at your optimism on the banking sector, it's varied here and there. What do the gloom people most get wrong?
Well, I'm not sure they're getting it wrong. They're just saying that it's what Brad referred to. There's a discounting mechanism as to when you are going to achieve your normalized earnings, and that keeps getting pushed out. And that's why I think the banks have been under pressure. There's too many uncertainties to quantify with a surety.
This has been wonderful. Thank you so much. Brad Hintz, Charles Peabody, thank you so much. I'm going to come back.